Hello and welcome to Midcap Radar. We welcome you with M&M's Q3 numbers. The company's top line has seen a growth of about 18%. This is driven by a 20% jump in the company's auto business. The EBITDA has come largely in line with street expectations. EBITDA number at about 4,400 crore rupees, and profits too have gone up by 20.8%. These are very slightly lower than street expectations, at least on the bottom line. On the bottom line, the CNBC-TV18 poll was for a growth of about 29%. Compared to that, the company's delivered about a 20-21% bottom line growth. But again, these are very strong numbers and the stock is holding up in the green. Margins in line at 14.4%. So top line growth 18%. Margins at 14.4%, and this is an expansion versus the 12.8% clocked in the comparable quarter of last year. So margins for the company are up 160 basis points, and that is driving a 21% increase in the company's profitability. Revenues in line, margins in line. Profits too are very healthy at 21%, but again, you would say maybe slightly lower than street expectations. M&M has been one of the best performing stocks. I think last year it was up close to about 80-85%, and in 3 years, the stock has given a return of close to about 250% because their SUV portfolio has been doing very well. Tractors, they've always been the dominant player, and that has been driving growth. So the volumes for the company have been very strong. I think in Q3, Sudarshan was telling us that volume growth was 16% in auto and about 20% in tractor. These are the internals. We've got the auto business numbers up 20% growth on a year-on-year basis. So, at least these are the few internals that we have right now. Auto business EBITDA seems to have seen an expansion because the top line growth is 20%. EBIT growth is close to about 37%.
Absolutely interesting numbers surely coming in, and there are going to be a lot of factors that one should watch out for in terms of commentary also, right? Like you were mentioning, volume 17% is what Sudarshan has highlighted. So keep an eye out on that. We'll also want to watch out for the ramp up that one could see coming in from the XUV 400. So what is that? Strong volumes is surely something that we're seeing coming in from the company. Auto segment, the EBIT that we're seeing is good. Agri-business EBIT is at 42% up YOY, 30% uptick on a quarter-on-quarter basis. The stock is seeing some bit of a gain and momentum coming in, and auto business a bit also is at 9.7% versus 8.5%. So we're seeing an improvement even coming in on the EBIT front of individual segments as well. So yes, largely when we're seeing in terms of estimates, margin has met the estimates of the street, revenue is in line with the street estimates as well, and overall versus the poll, even the EBIT performance has been good. Interesting to watch out for in terms of that front.
The stock is now moving up. Yes. It was up 0.5% when the numbers came out. It dipped a tad bit, but now again it's up close to about 1.5%. That's M&M for you. Pull up a 3-year chart of M&M or 2-year chart, and you would see the kind of outperformance M&M is clocked in vis-a-vis peers because its portfolio is doing very well. You know, the XUV 500, 700 has been sold out. There's a very, very long waiting period. Tractors, it's Tractors has also had a pretty good run given the monsoons have been normal. So M&M has been on the front foot, 85% up in the last 1 year, 250% in the last 3 years. And if you look at a 5-year CAGR on M&M stock price, it's given a return of 40%. So true wealth creator in the large cap space. Gurmeet Chadha, managing partner, CIO at Complete Circle, is now with us to discuss the numbers. Gurmeet, your initial thoughts on M&M?
Hello.
Yes, Gurmeet, we can hear you. Did you have a chance to go through M&M's at least?
Yeah. So I think a good set of numbers. I think if you see revenue, they've crossed 30,000 crore mark. EBITDA is, I think, in my view, again an all-time high at almost inching in at about 4,500 odd crores. And there is a bit of a margin expansion. I think what is good here is the fact that they've been focusing on, they've regained their market share in SUVs. It's back at about 20%. I think the new EV launch has happened. They've started the bookings. The response has been pretty good. I have a few clients who are very large dealers of M&M in North. I think there's a lot of excitement there. Tractors, they are gaining market share. And the best thing has been since Anish came over Yeah. Hello? Yeah.
Yes, we can hear you.
Anish came in. I think the focus on capital allocation has been pretty solid. They have cut down on loss-making, JVs they had, clear allocation towards how business is to be done. There was one bit of a blip when they bought some stake in RBL Bank, which Street did not like. But I think that clarification came that it was just an investment and they had no plans as such. So I think pretty constructive, and valuations I would say are modest, would not say reasonable. But I think the new EV and uptick in rural demand could still give some legs to M&M.
Okay, so Gurmeet, do wait on with us. We do have Sudarshan who's joining in with us, who's done some number crunching in terms of the M&M's Q3 performance. Sudarshan, what are they looking like versus the CNBC-TV18 poll? Any more highlights that you could shine on these numbers?
From the first look, it's looking a very strong set of earnings. Even expectations were elevated. Company has managed to meet estimates on all the fronts, whether you take auto segment or farm segment. So overall revenue was 30,500 crore against our expectation of 30,600 crore odd. So it's almost in line. EBITDA has come in at almost 4,400 crore. Again, in line with estimate. Margin company has managed to hold on to the levels above 14%. It has come in around 14.5%. That is also almost in line. If you talk about the segments, for auto business, revenue has increased 20% year on year, and even sequentially, if you look at, it's up 6%, and even EBIT is up 37% year on year and 8% sequentially. Agri business, again 21%, YY 26% sequentially. EBIT for agribusiness 42% up YY and 30% sequentially. So it's telling you, as in morning we were talking about the two segments, basically SUV and tractor. Demand has been strong for both these SUV and tractor, and the leader is M&M. So led by healthy volumes, company has managed to report a very strong set of numbers for Q3. But we have to see exactly what does company say on the demand front, if the demand is sustainable, and how is the demand going on in current quarter, and how the demand has been for the recently launched electric vehicles. So these two, and last is the considering the demand for tractor segment, if there is a pickup or if there is an increase in FY25 growth estimates, because currently it has been like mid-single digit growth. So if we'll have to see if M&M says that there is an uptick expected as well. So considering all these things, first, Q3, very strong set of numbers, but all eyes would be on company's commentary related to demand.
I remember earlier this month only, right, Sudarshan, they had launched those two, native electric, purely electric born vehicles. I think it was 6BE, something on those lines.
6BEV.
6BEV, yeah. And there was so much excitement around the stock price, on the prospects and what it will do. And it was also fairly competitively priced versus peers. So have they given any indication of the bookings for that?
So I'm yet to see exactly what the company has commented about bookings, but both those products were feature-rich products. And one advantage that all the brokerages were talking about, those two products are not only feature-rich, but the pricing part was very important, and company has managed to announce the price, and basically prices were very attractive. So considering these two factors, and I feel the demand obviously would have been strong.
Okay, thank you very much for that. The key positive is that growth continues for M&M, 18% top line growth, and both the auto business and the tractor, the farm equipment business is doing well, and there is margin expansion. Margins for the company have expanded from 12.8 to 14.4% on a year-on-year basis. That's a 160 basis point margin expansion, and that is something that the street likes. I think the question now is, because of the run-up, how do the valuations stack up?
Absolutely. Let's go across to Gurmeet on that front as well. And Gurmeet, like Rima was saying, how is it going to be in terms of valuation? M&M numbers have been good. Commentary is what everyone is watching out for. But on the valuation front, does it make a good bet right now?
I think it should be more like something which is very consistent in the large cap space. It's not stretched, it's not cheap. It's 25, 30 times, and this is one auto stock which hasn't really corrected, along with Maruti. Actually has done well in the crisis. See, other thing is, if you look at its powertrain a few years back, pre-COVID, it was 72% diesel. Right now, if you look at it now, the diesel is almost 50-55%. There is EV which they are launching. There is CNG which they have included. So even the powertrain now is catering to different segments, which I think augurs well. Depending on how the landscape is changing as far as clean energy goes. And I think this new EV launch, as I said, few of the distributors who are clients went for the launch in Chennai in their R&D center, and some had some great feedback on that. So I think they've just started the bookings. I think immediate trigger could be how strong the bookings are. Remember when they did this all 4 SUVs back to back, which is XUV 700, Bolero. If the bookings pick up, there could be some, although I'm not commenting on near-term movement, but there could be a bit of momentum in the near term because of that.
Okay, Gurmeet, thank you so much for joining in with us and giving us insights in terms of M&M's number, what we should be expecting in terms of the stock going forward as well. But key is going to be the commentary that we're keeping an eye out on. As of now, M&M is trading almost near the day's highest point, so keep an eye out on that. Let's move on, and the battle for control over Religare continues. Supreme Court of India directs the Burman family's open offer will not close today as scheduled earlier. Ashmit is joining in with us to give us more details on this one. Ashmit, what is the latest update that you have here?
Well, clearly the confusion as far as control of Religare continues. The open offer that had been issued by the Burmans was expected to close today, which was expected to give some finality to the matter. But bear in mind that the US-based, the Florida-based businessman, the investor Digvijay Gaikwad, had moved the apex court. That hearing was today, just concluded a few moments back. And importantly, in that hearing, the Gaikwad had essentially said that why are we asking the minority shareholders to settle for 235 rupees a share when I, Gaikwad, am offering 275 rupees a share. From therein, there were questions on technicality, and on the basis of that, essentially what the Supreme Court has directed as an interim direction is that, number one, the Burman open offer will not close today as was scheduled. The tendering process was expected to close today. That will not happen. Number two, the Supreme Court has directed for Gaikwad to deposit an earnest money deposit of 600 crore rupees by February 12th. That's Tuesday of next week. So they have time till Tuesday to make that earnest money deposit of 600 crore rupees. Third, and this is critical, the open offer that was issued by Burmans will remain open till the earnest money deadline of Tuesday next week, which is February 12th. Till Gaikwad makes that deposit on February 12th, this open offer will continue to remain open. The tender process will continue to remain open. And what happens in a situation that Gaikwad coughs up that amount of 600 crore rupees? In that case, the Supreme Court has added a fresh stipulation that this Burman open offer will remain open till SEBI takes a final decision on the Gaikwad application for an open offer. So clearly, there are a number of moving parts here. No finality yet, but for now, the Burman offer to remain open. But at the same time, the Supreme Court did make an observation that this open offer, them doing it at their own risk, the Burmans, because should the issue get decided in favor of Gaikwad's, the words of the Supreme Court were, they'll have to cough up a lot of money.
Okay, Ashmit, thank you so much for giving us the latest update on Religare. But let's just mark the flashes at the bottom of your screen. We have Ola Electric that has reported the numbers. Revenue seeing a decline of 19%. Losses have widened further for the company. EBITDA loss at 460 crore versus last year of 301 crore. Losses also are somewhere at 564 crores versus 376 crores. So clearly we are seeing that losses are widening. There's a bit more pressure coming in, and revenues also are seeing a decline. Stock has slipped in trade and is down almost 2% as of now.
I was just going through the Ola numbers. In Q1, the company's top line was 1644 crore. Yeah. In Q2, it came down to 1214 crore. So even in Q2, there was a sequential decline in the company's revenues, and that has further come down to 1045 crore. So we've seen a significant moderation in the absolute revenue number. 1644 in Q1 comes down to 1214 crore in Q2, and now down to 1045 in Q3. The Ola Electric stock price too has taken, a bit of a tumble. Right now it's down close to about 2.5%, but its 52-week high was close to 157 that it hit on the 20th of August. So from that level, 157 down to 70, the stock has more than halved in the last, 5-6 months. And the numbers are a bit disappointing. I remember even Q2 was a disappointing quarter, but losses have widened for the company, and the absolute bottom line loss is 564. And remember, shareholders, investors are going to have another option to play the pure electric two-wheeler space, because Aether Energy has also filed its DRHP and it's readying its plans for an IPO. So, you're going to get another choice, right? Option if you want to play for the entire EV penetration, you want to play that story, now you have an option there too.
Absolutely, but as of now, we're seeing pressure coming in on the stock. Numbers not looking that great. On that note, we're going to slip into a very short break, but don't go anywhere. After the break, we have more numbers to talk about. Aadhar Housing Finance, they've reported their numbers. What are the outlook of the company going forward? We do have the management waiting by. Welcome back and thanks for staying tuned into CNBC-TV18. You're watching Midcap Radar. Now let's talk to the management of Aadhar Housing. They reported their Q3 numbers. Disbursement saw good growth. AUM growth also seems to be healthy. To discuss more about the outlook of the company, also what these RBI MPC minutes decisions actually mean for the company, we do have Rishi Anand, Managing Director and CEO at Aadhar Housing Finance, joining in with us to talk to us all about that. Thank you so much, Rishi, for joining in with us this afternoon on CNBC-TV18. Let's just start before the earnings and talk about RBI's decision for the 25 basis point rate cut. What does that mean for you? What does it indicate for you? As well as we did have the budget that just ended recently. So the IT cuts that we saw, income tax cuts that we saw coming in the budget, do you think that is going to be spurring the demand?
Hi, Vinny. Good afternoon. Thank you very much for having me. Okay, first thing first, let's talk about the cut. Good news coming in after a gap of, if I'm not mistaken, about 4-5 years. This was on expected lines. I think the industry was expecting a cut of about 25 bips. That has happened. How is it going to impact our borrowings? We have approximately about 15,000 crores of borrowing, which are based on either MCLR or repo rate. Approximately about 10 to 12% of our borrowing is based on repo rate, which will have an immediate impact of the 25 bips cut. The balance funds that we have borrowed on MCLR will take anywhere between 3 to 6 months for us to look at the cuts. Eventually, as last time also I briefed that close to about 80% of our consumers are on floating rates. So whatever cut comes into us is going to be passed on to the consumer. So it is obviously good news for the consumer. You touched a topic on the budgets. On the budgets, couple of good news that came in. One was the income tax slab, zero tax up to 12 lakhs. This is eventually going to propel the demand because the loan eligibility in home loans typically will rise by about 3-4 lakh rupees. Apart from that, what didn't come out in the budget and was announced about, I would say, 15 days prior to budget was something called the Mortgage Guarantee Fund, which was targeted for the EWS LIG segment. So the Mortgage Guarantee Fund, the gadget has been rolled out. It has now become a policy that's going to further propel the demand. Adding on to it, the Sumi 2.0 fund.
Rishi, hi. Rima here. Good to chat with you and good to see you. So I think you'd given a guidance of a disbursement growth of 18 to 20% for FY25 and an AUM growth guidance of 20 to 22%. One, does that hold for a full year? And secondly, for FY26, given the tailwinds, do you think FY26 you could do better than FY25?
Oh, hi, Nima. Good to see you and talk to you again. We stand by our guidance number for the year at 18-20% disbursement growth and 22 to 24% AUM growth, which will translate to about 20% growth in PAT. As regards the next financial year that's in question, I think similar numbers we would stand by and give a guidance on, which is about 20 to 24% AUM growth.
Right. Rishi, one more point that I want to just pick up on is in terms of NIMs. They seem to be a bit under pressure during this quarter as well as your spreads. They've contracted. So I'm just trying to understand what is the outlook behind this and what actually impacted both of these factors.
I think I would say yes, there is about 30 bips. If you look at the NIMs, there is a decrease of 30 bips from a 9.5 to about 9.2. It was a combination of incremental yield. So the yield on the book falling by about 10 bips and the cost of fund impact of about 30 bips. I think combination of both impacted the NIMs that we're talking about.
And what is the outlook for the NIMs going forward then? What will be driving them? What are you keeping as a target?
So the way we look at it, Vinny, it is going to be in the range of 9.1% as we move ahead in the next financial year.
Okay. Gross NPAs, I think, are closer to 1.4%. What is the outlook on the asset quality? Do you think in Q4 things improve?
Yes, Rima, the way, our industry works is generally in Q3, because of the festivities, you would see anywhere between 25 to 30 bips drop in the GNPA numbers as we hit Q4 and March end. So from here on, we're looking at about 1.1% kind of GNPA numbers of March 31st.
Okay. Just getting back, is there any number on NIMs and spread that you shared? I kind of missed it if you did.
I indicated NIMs to be in the range of about 9%, even as we move ahead, Rima.
And this will be 9% as an exit for FY25, or what will be sustainable going ahead?
Sustainable for the next 1 year as well. And current spreads, we are in the range of about 5.8. And, the way we look at current year, we should be exiting at about 5.75 and stable state next year, 5.7.
Okay. And, Rishi, one more thing that I want to know in terms of provisions also. Sequentially, they're seeing a bit of an increase. What is it that we are expecting over there and in terms of provisions, as well as how do you see the credit cost trending going from here on?
So credit cost, Vinny, should be, we've always guided, will be in the range of 25 bips to 27 bips, provisioning 35%. And we stand by those numbers for the current year and for the next financial years in terms of guidance.
Correct me if I'm wrong, but I think the share of your non-housing loan book is about 26%, and that's a number which has been trending. That's a number which has been trending up.
So Rima, the way it works is, we work under something called the principal business criteria, which says 60% of your book has to be individual home loan at the balance sheet level, which would translate to 70-30 on a standalone basis, home loan, non-home loans. I would say we still have room. We are 74-26 as we on the book level as we see today, and we still have a room about 3-4%. Having said that, 75-25 kind of number is what we are looking in the long term.
Okay.
Home loan to non-home loan.
Sure. And also, what is the impact of this also? Because salaried versus self-employed, the mix over there also has been changing over the years, right? I believe salaried the mix was around 65 in FY18. Now it's come down to 56, if I'm not wrong. Yeah. So how does that mix also change? And do you see this changing further and salaried mix reducing going forward?
Vinny, I would say, yes, you're right. 2018, we were at about 64-65% salaried. I think it is more by design every year, and we've indicated this multiple times. Every year by design, we will increase the self-employed portfolio by 1.5%, and the salaried obviously substantially drops. So as we go ahead, couple of years down the line, let's say 1.5% per year, the self-employed portion will increase. And we should I would say, balance out at about 50-50%.
Thank you very much for that. I remember the IPO price was, I think, about 300, 315, thereabout. Stock is down well. It's now above 400 rupees. That's Aadhar Housing Finance. Get into a break. On the other side, the management of Motherson Sumi Wiring joins in to discuss their Q3 earnings. Welcome back. Motherson Sumi Wiring is the next company on our radar. The stock is under a bit of pressure because the margins disappointed the street. Margins of the company have come off quarter on quarter and on a year-on-year basis. Mahendra Chhabra, CFO of the company, and Anurag Gehlot, COO at Motherson Sumi Wiring, are with us on the show now. Gentlemen, thank you very much for joining in. Mr. Chhabra, if I may start with you. First, explain to us the margin performance. What led to the sequential and year-on-year drop in EBITDA margins to 10.3%? And will the pressure persist? Because there are some startup investments that you're doing. So will that continue to be a pain point? Will Q4 margins be at similar levels? Do they go reduce further from here?
Yeah, so first of all, thanks for getting us on CNBC. So as far as margins are concerned, like we have clarified, we are putting up 3 new plants. And whenever there are new plants, the initial ramp-up costs in terms of manpower, retaining and training the manpower, and those costs are directly charged off to the P&L, and that's the reason we see margins looking in this shape. But if we exclude the impact of the new plants that we are putting up, our margins from the existing plants are up by 6% year on year. And as far as future outlook is concerned, So like we are putting up 3 plants, out of which one would be operational within this quarter completely, and the other 2 will get operational in Q1 and Q2 of next financial year. So as and when plants keep on getting operational, we should get better revenue from those plants in line with the customer forecast, and profitability should get better.
Oh. So just to complete the point on the margins, and Mr. Gehlot, if you could come in, what was the extent of the investments that you made in your new facilities? Trying to understand that if it wasn't for that, what would the EBITDA margins look like? And again, if you could give that number and tell us in Q4 or in Q1 of FY26, what would be the incremental investments that you need in your new facilities?
Okay, thank you. First of all, thank you very much for taking us on CNBC. As Mahinder has said that these 3 new greenfield, if we are excluding those, and if we see the EBITDA, it is already 6% year on year. The good news is that these 3 new greenfields are in line to the expansion plan of the customer, and these models which we have won, they are new models. They are not a replacement or mid-year update of any of the vehicles. So these are the new volumes, and one of the plant has already under ramp up, and the other 2 plants are going to be ramp up in next coming 2 to 3 quarters. Now, these volumes, it's all subject to what customer is going to make, but we see a very positive side that we are expanding ourselves in line to the customer expansions.
Right. Good afternoon, gentlemen. This is Vinny joining in the conversation as well. Mr. Chhabra, just to follow up, is that then when will they start normalizing the 12 to 13% range, which you all had in terms of margins? If your plant setup is going to get completed by the second half of FY26, post that, could we see those margins starting to see that improvement back?
Yeah. So see, as an organization, we focus on ROAS. That's how we measure the overall financial health of the business. And we have a guidance that we should be delivering a ROAS of more than 40%. And that is what we have been delivering in the last 2 years. And even in the current year, if we get the orders for the Q4 as in line with the customer forecast, we should be able to deliver more than 40% ROAS. And as far as EBITDA margins are concerned, as and when these plants get into ramp-up mode, the ramp-up mode is over and the production starts, the EBITDA margin should also get better.
Okay. Anurag, what I also want to understand is that what some data points are suggesting that in Q3 seems like the EV contribution has seen a bit of a reduction. Is that a fact? And if yes, how much has it seen a reduction by?
Yes, if you are seeing that there is a reduction in EV or the electric vehicle, that is correct. And we are seeing that bit also in our revenues as well. But you have to understand that this year it's remained to be very exciting for the automotive sector because OEMs has launched many new models across EV as well as ICE, and keeping a lot of it's a heavy feature, rich feature content vehicles. So when these launches are happening, and as you have seen in our press release also, that in this quarter and the next 2 to 3 quarters in the new plants, there are both ICE and EV both. So I think it's just a matter of time. We have to see how the consumer is going to react to the new launches. And we are very hopeful because we never doubted our customer, and whatever they are putting the volumes to us. So I think it's going to take some time, but you will see a very positive results in coming times.
Mr. Chhabra, the 3 greenfield plants that you spoke about, which are at different stages of completion, I believe have a revenue potential of 2,100 crore rupees. Is that right?
Yeah, that's right. So when these plants reach at their optimum level in terms of their production, and if the orders are in line with what the forecast we have received from the customers, on an annualized basis, these 3 new greenfields should give us 2,100 crores turnover.
So realistically, how much of that can come in FY26 to your mind?
So it depends on the time when these get actually ramped up. So by H2 26, we expect this to kind of get at those levels, depending on the customer orders.
Okay. So is it okay to estimate that at least 50% of the potential, we're talking about 1,000 crore of incremental revenues in FY26 because of these greenfield?
Well, if other things remaining the same, yes.
Okay. Mr. Chhabra, I just wanted to understand one thing. Right now, I'm looking at the growth rate over this year, right, in FY25. for the first quarter was 17%, moving on to second quarter 10%, and now the growth rate has been around 8-9%. I just want to understand, we've seen a bit of the growth rate slowing down. What is the outlook in terms of the growth that one should watch out for? Any growth guidance or number that you would give for Q4 as well as for FY26?
Yeah, sure. So as far as growth is concerned, I mean, the growth is a factor of a couple of factors. It's a matter of a couple of factors. So for example, the product mix that is there and the content in the wiring harness. So today we know that customers are preferring feature-rich models, and those feature-rich models have a high amount of content and more revenue for us. So a lot would depend on the product mix that is there, that gets sold to the consumers. And if you look at, we have been ahead of the industry. So if you look at Q3, we are 9%. We have 9% growth, whereas the PV industry grew by 3%. So we outpaced the market by 6%. Likewise, if we look at 9 months, we have grown by 12%, whereas the PV industry has again grown by 3%.
So 9-month revenue growth is about 12%. And will you, based on the early indications, Anurag, do you think you can end the year with about this 12-13% top line growth?
I think it's all subject to the volumes what the customer has forecasted. We are very positive. The way we are going in 9 months, it's already 13%. So we have to see, as Mahindra has suggested, that what sort of consumer are buying the models. So the higher the model, the higher the content, and the sales value for MSL goes high.
Okay, and just the last one, I just want to understand raw material trends and the raw material prices. They have been quite stable, right? Anurag, is there any change and any concern on that front?
I think, yeah, raw material costs are, you have seen there is not a very big change, or there is no abnormality into that.
Thank you, Mr. Chabra and Mr. Gehlot, for joining in, and wish you all the very best. Look, enjoyed chatting with you today. We'll slip into a very short break on that note. We'll come back with more on the market. It's in the red now for all the benchmark indices. The Nifty is closer to 23,500, down 80 points. Sensex down 360.
Welcome back, and thanks for staying tuned in to CNBC-TV18. You're watching Midcap Radar. Quickly, let's just look at Alkem Labs. They reported their numbers a short while ago. Doesn't seem like a great set of numbers that has come in from the company. For the quarter gone by, the growth has just been of 1.5%. Domestic sales have seen a growth of around 5.9%, 6% approximately. And international sales, they have seen a decline this time of 6.2%. Margins, yes, some bit of an expansion that they're seeing coming in terms of margins, but overall, the sales growth hasn't been that good, and expectation was much higher in terms of the domestic formulation growth as well as the international business growth for the company. So obviously it's important to watch out for what is going to be the outlook of the company. As of now, concerns are coming in terms of the growth factor. Alkem Labs, that's as of now, is trading at the day's lowest point. That's a weak set of numbers from Alkem Labs. You have Century Ply also that has reported their numbers just now. Net profit is seeing a decline of 7.3%. Keep an eye out on Century Ply. Revenue seen a growth of 22%, and Century as of now is of the day's highest point. We'll wait out for more internals coming in for Century Ply. But let's move on and talk about NCC, because that's a stock that's in focus as well on the back of its numbers. They reported a weak set of Q3 FY25 numbers. So Darshan is joining with us to give us those details.
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5% versus earlier guidance of 15%. And margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance, and because of that, you are seeing a big fall in NCC.
Absolutely, a 12% fall as of now for NCC. Now let's move on, and it's actually time for Growth Code, which is a special initiative by Grow and CNBC-TV18, designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there is obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Welcome back. Bharti is undoubtedly the big mover today, and that's because their Q3 numbers were actually pretty good. Now, if you go by just the pure numbers, on the P&L, they're not strictly comparable because now Indus Stars is a subsidiary of Bharti Airtel, and there was a line-by-line consolidation. So numbers are not strictly comparable, but let me run you through some of the key pointers in the numbers. One, the average revenue per user. That's basically your monthly bill. It's the amount a customer pays per month. And that has been steadily inching up. 5.1% quarter-on-quarter, 18% on a year-on-year basis. It stands at 245 rupees, very close to Sunil Bharti Mittal's aspiration that this number needs to hit 300 rupees for the industry to be sustainable. So it's at 245, and there's been a steady progression in that number. Secondly, the number of customers. We call them subscribers. Now, subscribers declined in Q2 because of the tariff hike. It was a sudden increase of 15-16%. Some customers fell off the network. But this quarter, subscribers have bounced back up 5 million on a sequential basis. That's positive.
So that's an important point coming in especially for these
Exactly.
companies.
So despite the tariff hike, subscribers on a two-quarter basis are higher. Thirdly, it's better than its peers. So the India mobile business, because Bharti has Africa, it has homes, enterprises, many businesses, but purely the mobile business for Bharti Airtel has done better than Reliance Jio. In terms of revenues, 5.8%. And fourthly, and the more important one, that the tariff hikes by the industry took place in July. So effectively, Q2 and Q3, both of them had the benefit of tariff hikes. Why even Q3? Because sometimes you have a 3-month plan, you have a 6-month plan, you have a 12-month. So that pass-through takes time. But in Q2 and Q3, the company's revenues went up 17%, which basically means that the full tariff hike has been absorbed. It's not that because of the tariff hike, they lost some, customers, there was down trading, they moved to lower price. That pass-through full benefit of the tariff hike has largely taken place, and that also is a positive.
Absolutely. That's why Bharti Airtel is managing to hold on to good gains of 3 to 4% in trade. But let's move on. And LIC also is something that we're keeping an eye out on. They're set to report their Q3 numbers today. Yash is joining in with us to tell us what are we expecting this time from LIC. Yash?
Yes. Well, as far as the stock is concerned, it's corrected significantly. It's about 32% off its 52-week high. the numbers expected for the third quarter are on the weaker side. As far as new business premium is expected, that is expected to see a decline of about 23%, coming in at about 42,406 crore rupees. Total APE, that is expected to see a decline of about 18% at about 10,789 crore rupees. Retail APE is expected to decline by about 18%. Again, it's about 7247 crore rupees. Importantly, value of new business, that is expected to see a decline of 30%. At about 1836 crore rupees. Margins expected to see a contraction of about 298 to about 300 basis points. Expected at about 17.02% versus 20% on a year-on-year basis. It becomes particularly important because if the numbers do come on the weaker side, then the management's guidance for FY25, that will be questioned, and it will be very important to see if they plan to stick to that guidance of AP guidance of 15%, VNB guidance of 18%, and margin guidance of 19 to 20%. Or is there any change that comes through as far as FY25 guidance is concerned? Apart from the guidance, what will be important to see the increase in non-par share of the business, any movement in management's plan to acquire a health insurance company, and finally, the impact of surrender value regulations on their VNB margins.
Thank you, Yash, for that. By the way, markets have slipped. We've given up 23,500. The Nifty is down to 23,450. Yes, we did get that 25 basis points rate cut, but that perhaps was so widely anticipated that it's not had any impact on the markets. The Nifty Bank is now down a full percentage point. We're going to take your leave on this show. Thank you for watching. Don't go anywhere. Last 1 hour of the week coming up with our closing bell anchors.